Eleanor, at 78, had always prided herself on her financial independence. Her home, fully paid off in a quiet suburban neighborhood, represented decades of hard work and a significant real estate asset. Yet, when unexpected medical expenses surged past her long-term care insurance limits, Eleanor found herself facing a difficult choice. She could deplete her carefully managed retirement savings, or consider a financial tool often pitched as a savior for older homeowners: a reverse mortgage. This decision, seemingly straightforward, would profoundly impact her financial security and peace of mind. A reverse mortgage allows homeowners aged 62 or older to convert a portion of their home equity into cash. Unlike a traditional mortgage, you don't make monthly payments to the lender. Instead, the lender pays you, either as a lump sum, a line of credit, or monthly installments. The loan becomes due when the last borrower leaves the home permanently. This can be a critical source of liquidity for those with substantial home equity but limited cash flow, especially when facing rising healthcare costs or simply needing funds for home modifications to support aging in place. Data from the U.S. Department of Housing and Urban Development, HUD, indicates that around 60,000 to 70,000 reverse mortgages are originated annually. While they serve a niche, they are not without risk. AARP research highlights that a significant percentage of borrowers, particularly those facing financial distress, may not fully grasp the long-term implications. Understanding the product is crucial, as fees and compounding interest can erode home equity faster than anticipated, impacting the estate value for heirs. It's a complex financial strategy, not a simple cash injection. Eleanor's situation exemplifies a common dilemma. Her home equity was her largest asset, but it was illiquid. The promise of immediate funds to cover medical bills, without the burden of monthly loan payments, felt like a lifeline. However, the initial appraisal showed the loan amount would be substantially less than her home's market value. Furthermore, closing costs, origination fees, and ongoing mortgage insurance premiums meant a significant portion of her equity would be used up before she received any cash. This is a critical point many potential borrowers overlook. The problem deepens when borrowers don't maintain their property, pay property taxes, or keep up with homeowners insurance. While no monthly mortgage payments are required, these obligations remain. Failure to meet them can lead to foreclosure, even if significant home equity still exists. This is a stark reality for approximately 10% of reverse mortgage borrowers, who, according to a recent Consumer Financial Protection Bureau report, default on these requirements. For Eleanor, ensuring these ongoing costs were covered would add another layer of financial planning. Before considering a reverse mortgage, explore all alternatives. Could a home equity line of credit, HELOC, or a traditional home equity loan be a better fit, especially if you can still manage monthly payments? Downsizing your home might release substantial capital without incurring new debt. Even exploring government assistance programs for healthcare costs or property tax relief can provide needed financial stability. A holistic approach to retirement planning often reveals solutions that preserve more of your wealth for longer. When a reverse mortgage is the right choice, always seek independent counseling from a HUD-approved agency. This is a mandatory step. These counselors can help you understand the terms, fees, interest rates, and long-term implications. They can also explain how the loan balance grows over time due to compounding interest and how it affects the inheritance for your family. This educational component is vital for making an informed decision that aligns with your overall estate planning goals. Understand the terms. Your home equity is your financial future. One critical detail often overlooked is the non-recourse nature of most reverse mortgages. This means borrowers or their heirs will never owe more than the home's value at the time of sale, even if the loan balance exceeds it. While this protects heirs from personal liability, it also means the remaining equity, if any, could be significantly reduced. For families relying on property as a primary inheritance, this financial tool can drastically alter generational wealth transfer. It is essential to discuss these implications with your family. Furthermore, variable interest rates can cause the loan balance to grow unpredictably. While fixed-rate options exist, they often come with higher upfront costs or limited payout options. The choice between fixed and variable rates depends heavily on your financial strategy and risk tolerance. It's a key factor in how quickly your home equity is consumed. Prudent wealth management involves understanding how these interest rate structures interact with your longevity and future healthcare needs. Informed decisions build lasting financial peace. After extensive research, consultations with a HUD-approved counselor, and frank discussions with her children, Eleanor made her decision. She recognized that while a reverse mortgage offered immediate relief, the long-term costs and impact on her estate were not aligned with her financial goals. Instead, she chose to utilize a low-interest HELOC for the immediate medical bills, paired with a strategic review of her other investment accounts to optimize cash flow. This provided the liquidity she needed while preserving more of her hard-earned home equity.